Misstatements can arise in financial statement can arise from fraud or error. Fraud is an intentional act by one or more individuals among management or TCWG, employees or third parties to obtain unjust or illegal advantage, whereas error is an unintentional act. Fraud is an intentional act by management, TCWG, employees or third parties. Error is an unintentional act. Auditor shall be concerned with fraud that causes material misstatement in financial statement. Two types of intentional misstatements are relevant to the auditor: fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting. Fraudulent financial reporting involves intentional misstatements or omissions of amounts or disclosures in financial statements to deceive users of financial statement. It may be accomplished by following sources of fraudulent financial reporting: manipulation, falsification, or alteration of accounting records; misrepresentation or intentional omission of significant information in financial statements; intentional misapplication of accounting principles. Sources of fraudulent financial reporting: three things: manipulation of accounting records, misrepresentation, and misapplication of accounting principles. Next one. It often involves management override of controls. Fraud can be committed by management overriding controls using techniques used by management to override controls: recording fictitious journal entries to manipulate operating results, inappropriately adjusting assumption and changing judgments, omitting, advancing, or delaying recognition of transactions in financial statement, concealing or not disclosing facts, altering records and terms. Total 5. Recording fictitious journal entries, inappropriately adjusting assumption, omitting recognition of transactions, concealing facts, altering records. Next one, misappropriation of assets. Misappropriation of assets involves theft of entities' assets and is perpetrated by employees in small and immaterial amounts. It can also involve management who are able to disguise and conceal misappropriations in ways that are difficult to detect. Misappropriation of assets involves theft of entities' asset is perpetrated by employees in small and immaterial amounts. It may be accomplished by following. Misappropriation of assets can be accomplished by following: embezzling receipts, stealing physical assets or intellectual property, causing entity to pay for goods and services not received, using entity's assets for personal use. 4 things: embezzling receipts, stealing physical assets, causing entity to pay for goods and services not received, entity's assets for personal use. Fraud risk factors. Fraud risk factor means events or conditions that indicate incentive or pressure to commit fraud or provide an opportunity to commit fraud. Incentive or pressure to commit fraud or provide an opportunity to commit fraud. Fraud risk factors. Hence, fraud risk factors are classified according to 3 conditions. 3 conditions are needed for fraud risk factors. They are incentives, pressures, opportunities, and attitude or rationalization. Incentive or pressure to commit, opportunities, and attitude or rationalization. Fraud risk factor can be related to misstatements arising from fraudulent financial reporting and misappropriation of assets. Fraud risk factors relating to fraudulent financial reporting are 3 types. First one, incentives and pressure. What are the incentives or pressures which are relating to fraudulent financial reporting? For fraud risk factors: high degree of competition, significant decline in customer demand, recurring negative cash flows or operating losses, new accounting or statutory or regulatory requirements, need to obtain additional debt or equity financings to stay competitive. Incentives or pressure: high degree of competition, significant decline in customer demand, new regulatory requirements, financings to stay competitive. Opportunities of fraud risk factors relating to fraudulent financial reporting: significant related party transaction not in ordinary course of business, significant estimates that involve subjective judgments, significant unusual or highly complex transaction, significant bank accounts or branch operations in tax haven jurisdictions. 4 things: significant related party transaction not in ordinary course of business, significant estimates that involve subjective judgment, significant unusual or highly complex transaction, significant bank accounts or branch operations in tax haven jurisdiction. Attitude or rationalization. For the examples of fraud risk factors relating to fraudulent financial reporting are 4 things: non-history of violations of laws and regulation, management failing to remedy non-significant deficiencies in internal control, recurring attempts by management to justify inappropriate accounting, restrictions on auditor that inappropriately limit access to people or information. Non-history of violations: failing to remedy non-significant deficiencies in internal control, recurring attempt by management to justify inappropriate accounting, restriction on auditor that inappropriately limit access to people or information. Examples of fraud risk factors relating to misappropriation of assets are three things: incentives and pressures. 2 points. Personal financial obligation may create pressure on management and employees to misappropriate asset. Adverse relationship between entity and employees may motivate employees to misappropriate asset. Adverse relationship may be created by future layoffs, recent changes to benefit plans, rewards inconsistent with the expectation. Opportunities, as an example of fraud risk factor related to misappropriation of assets are large amount of cash on hand. Opportunity. Inventory or financial assets are of small size and high value. Inadequate internal control over assets. Attitude and rationalization. Three things. Disregard for internal control. Behavior indicating dissatisfaction with entity. Changes in lifestyle. Next point. Responsibilities of TCWG or management and auditor in case of fraud. Responsibility of TCWG or management. Primary responsibility for prevention detection of fraud is of TCWG or management of entity. Responsibility of auditor. Auditor is responsible for obtaining reasonable assurance that FS as a whole are free from material misstatement, whether caused by fraud or error. Due to inherent limitations of audit, there is an unavoidable risk that some material misstatement may not be detected, even though audit is properly planned and performed as per SAs. Risk of not detecting material misstatement is resulting from fraud is higher than of from error. This is because fraud may involve organized schemes designed to conceal it. Risk of not detecting material misstatement resulting from management fraud is greater than employee fraud, because management can manipulate accounting records, present fraudulent financial reporting, financial information, or override control procedures. Audit, in summarize, responsibility of auditor is for obtaining reasonable assurance of FS free from material misstatement by fraud or error. Unavoidable risk that some material misstatement may not be detected. Risk of detecting fraud misstatement from fraud is higher than from error. Risk of not detecting management fraud is greater than employee fraud. Next one. Auditor shall identify and assess wrong due to fraud at financial statement level and assertion level. It is a presumption that there are risk of fraud in revenue recognition, cash balance, etc. in case of lack of controls in these areas. Risk of fraud is a significant risk. Auditor shall determine overall responses to address assessed wrong due to fraud. If auditor identifies a suspects a fraud, he shall communicate the fraud to management. If fraud involving management, he shall communicate to TCWG. Auditor shall also determine whether there is a responsibility to report the fraud to regulatory authorities. In case of companies, auditor shall report fraud as per 143(12) of Companies Act and clause 11 of para 3 of CARO 2020. Audit procedures responsive to risks related to management or override of controls. Auditor shall design and perform audit procedures to test appropriateness of journal entries recorded in general ledger and adjustments made in financial statement. Review of accounting estimates or biases. For significant transactions that are outside the normal course of business, evaluate whether business rationale of transactions suggests that they have been entered to engage in fraudulent financial reporting. Auditor shall design and perform audit procedures to management or override of control data. Test appropriateness of journal entries, review accounting estimates or biases, transactions that are outside the normal course of business rationale. Impossibility to continue the performance of audit. As a result of misstatement resulting from fraud, auditor encounters exceptional circumstances that bring questions to auditor's ability to continue performing the audit. Auditor shall determine professional and legal responsibility to report the person who made the audit appointment or regulatory authorities regarding fraud. Consider to withdraw from management if withdrawal is legally permitted. If auditor withdraws, discuss with the appropriate level of management or TCWG regarding auditor's withdrawal reasons for withdrawal. Determine professional and legal requirement to report the person who made audit appointment of regulatory authorities regarding auditor's withdrawal and reasons for withdrawal. Next one, management representation. Auditor shall obtain written representation from management or TCWG that they acknowledge their responsibility for design, implementation, and maintenance of internal control to prevent and detect fraud. They have disclosed to auditor the results of management's assessment of risk. Disclosed auditor to knowledge of fraud or suspected fraud affecting from the entity. They disclosed to the auditor knowledge of any allegations of fraud or suspected fraud communicated by employee, former employees, regulators, and others. Acknowledge their responsibility control in internal control to prevent detect fraud. Disclose results of management assessment of risk. Disclose fraud or suspected fraud. Disclose any allegation. Then the Auditor shall obtain representation from management or TCWG.